Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 188 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to talk about how to put a specific value on a stock, how to go through stock valuation, and what techniques you could use, how you can go about this particular process in order to pick good common stocks for your portfolio and how to make really good abnormal returns over the long term based on any type of valuation that you may do. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So when you buy an individual stock, what is the entire idea? The entire idea is to buy something that is going to increase in value for you. Now, that value could be the potential price of the stock, which that's in most cases what we're looking at, but it could also be in the income that that stock provides for you. But either way, you need increases in value in order to make returns. As a residual owner of the firm, like we talked about yesterday, you need some type of residual value increase in order to increase the value of your holdings, to increase the value of what you are invested in. And in order to do this, right, in order to find something that we can make some type of gain on in the market, to make some type of positive return, and not just positive return, but some type of abnormal return, because that's why we're investing in individual stocks in the first place, is because individual stocks are a place where you can find abnormal returns, meaning returns that are different from the market, meaning greater than those of the market. Now, this is very, very difficult to do, and I've talked about many times why I don't think individual stocks are good for everyone. So I don't think everyone necessarily needs this particular episode, but anybody who's interested in picking out individual common stocks like I do, I think this would be a good place to start. This would be a good place to understand how to value a company and things you need to take into account when it comes to determining what a company is worth. Because what you want to do is when you're investing in anything, right, you want to determine what that thing is worth today, and you want to determine if what it is priced at today is less than, greater than, or equal to what it is worth today. And hopefully what you can find is something that is priced below what it is worth today. And therefore you can buy it for less than what it is worth, and then let the market price eventually catch up to the value, and you will make really good gains on whatever stock you decide to invest in. Now, this is not an extremely straightforward process. It's not a science. This is definitely an art. This is something that differs with every single company that you go about trying to value. But I think a good place to start here is just understanding what valuation is in the first place. So valuation is the analytical process of determining the current or projected worth of an asset or a company. Okay, so that's exactly what we're trying to do. We're trying to put some current or future value on a particular company. All right. Now, there are many techniques used for doing evaluation. An analyst placing a value on a company looks at the business's management, the composition of its capital structure, meaning the amount of debt and equity that it has outstanding, the prospect of future earnings, so what its bottom line is going to look like in future years and future quarters for that matter, the market value of its assets, so how much its assets are actually worth in the market today, and then all types of different metrics. Now, what is most often employed when it comes to determining the valuation of a particular company, determining what they are worth, this idea of intrinsic value. When we're talking about intrinsic value, we are talking about what they are worth today. What is typically employed is this idea of fundamental analysis. Okay, although several other methods may be employed, There are other models such as the capital asset pricing model, otherwise known as the CAPM, or the dividend discount model, which we will talk a little bit more about as we move forward. But regardless, we are trying to use fundamental analysis. We are trying to look at the fundamentals of a company, meaning their financial statements, meaning statements of fact, meaning real things associated with the company, real numbers, real growth, real things that have happened in the past and that are currently occurring within the company in order to put some value on the company today or in the future. That's the whole idea of valuation, okay? And so how do we do this? How do we put some value on a company? What are we supposed to do? Well, what I first want you to understand is exactly why you would want to put a value on a company at all. So before you purchase a stock, it is important to understand that the stock's intrinsic value is not necessarily tied to the market price or the market value of that company, though some would have you believe that it is. In fact, there are many who buy into the efficient market hypothesis, a theory that states that all known information is currently priced into a stock. So the implication of this theory is that beating the market is almost purely a matter of chance and not one of expert stock selection, which we've seen with many individuals over the course of time, that the efficient market hypothesis does not necessarily hold all the way through, that it is not necessarily a strong form market efficiency, meaning that all information at all times is priced in. That just is not the case. Most adherents to this theory simply suggest that investing into an index fund or ETF is the best way to go because it is seemingly impossible to invest in common stocks and make outsized returns. And I'm not going to lie, it is very difficult to do so. Okay, it takes a lot of work, it takes a lot of homework, it takes a lot of this fundamental analysis. And I tell you that any money that you are going to invest, the vast majority of money that you're going to invest should go into index funds or ETFs or things of the like. But any extra money, some extra amounts of money that you want to make abnormal returns on should be used for individual stocks if you have the patience and the wherewithal to invest in individual stocks. Okay, so while it's hard to argue with that advice, passive indexing, is very, very good as far as long-term returns. It also doesn't take too long to see the holes in the theory. So for starters, how does the efficient market hypothesis take into account stock bubbles? So October 19th, 1987, Black Monday is a big drop, right? We also had the big drops of the Great Depression and the tech bubble, all these different types of things, right? If the efficient market hypothesis were true, one would be hard pressed to explain how the market could lose 25% in a day unless it was extremely overvalued before the crash or severely undervalued after the drop, okay? So rather, active investors believe that market swings between euphoria and pessimism on a fairly regular basis. Like that's a normal thing. It does swing back and forth. The father of value investing, Benjamin Graham, who was the teacher of the Oracle of Omaha himself, Warren Buffett, okay, emphasized this aspect of the stock market, believing it regularly overvalued and undervalued in publicly traded companies. And in his classic book, The Intelligent Investor, this is what he wrote. He said, imagine that in some private business you own a small share that costs you $1,000. One of your partners is named Mr. Market. He's very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes this idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value that he proposes seems to you to be a little short of silly. And so active investors believe that a stock's value is wholly separate from its market price. So Mr. Market here being the market price that is given to us on a daily basis, and the actual intrinsic value being different from that. And so investors use a series of metrics, simple calculations, and qualitative analysis of a company's business model to determine its intrinsic value, then determine whether it is worth an investment at its current price. Okay, so all we're trying to do here is we're trying to say, okay, based on the fact that we think that things can be undervalued or overvalued, okay, we want to look at companies that we like. We still want to take the same approach that we've talked about in picking common stocks. We want to find something that we understand or that we like, and then do the homework, because valuation is part of doing that homework. And so our homework is going to be to determine if this company is trading for more or less than what it is actually worth in the market, right? And if we can determine that a company has good long-term growth prospects, it's got a strong competitive advantage, and we find it undervalued in the market today, then it may turn out to be a good investment for us. Okay, but then the question becomes, what are ways that we can do this? Well, there are several methods for stock valuation. There are many that are plausible, and then there are some that are not so plausible in most situations. But they really come down to two different types. You either have absolute valuation or you have relative valuation. And absolute valuation comes down to finding that intrinsic value, that true value of an investment based only on its fundamentals, based only on the company's financial statements, their net income, their cash flows, their revenues, their operating incomes, all these different types of things, right? That is what we are most interested in. And if we could do it perfectly, that would be great. But that is not the only way that we can value a company. We can also do what's called relative valuation. So in contrast, what relative valuation does relative to the absolute valuation methods, it operates by comparing the company in question to other similar companies. So this involves calculating multiples and ratios such as the PE or price to earnings ratio, where it's the share price divided by the earnings per share for that company, and comparing it to the multiples of similar companies. So for example, if the PE of a company is lower than the PE of a comparable company, the original company might be considered undervalued relative to the comparing company. Typically, the relative valuation model is a lot easier and quicker to calculate than some absolute valuation model, which is why many investors and analysts begin their analysis with this model. And I cannot disagree with the fact that relative valuation can be very, very useful, especially when you have companies that definitely fall into similar buckets, right? It's really easy when you have companies that fall into similar industries or similar lines of business. And if you can compare them directly and then maybe see what may impact the valuation of one versus the other, see if there's any material differences, you can relatively value a company and see if it is overvalued or undervalued relative to its industry and its industry peers. Okay, and so that is something that you can absolutely do. But let's say that we are going to find the absolute valuation, right? Because that's going to give us a more direct decision of exactly how much something is worth and comparing that to what the current market price is today. So the first model that we could talk about is the dividend discount model. And all these models, you can look them up. It's not hard to find information on these different models we're going to talk about. But the dividend discount model is one of the most basic absolute valuation method models, right? The dividend discount model calculates the true value of a firm based on the dividends the company pays its shareholders. The justification for using dividends to value a company is that dividends represent actual cash flow going to the shareholder. So valuing the present value of these cash flows should give you a value for how much the shares are worth in today's dollars. Okay, so the first step is to determine if the company pays a dividend. Now, the problem with the dividend discount model or the dividend growth model, if that is something that you may employ as well, is that these models require that the company pay a dividend, because if the company does not pay a dividend, then we have no way of knowing exactly what value to put on this company because they don't pay dividends. Okay, but determine if they pay a dividend. If they do, determine whether the dividend is stable and predictable, since it's not enough for the company to just pay a dividend. The companies that pay stable and predictable dividends are typically mature blue chip companies in well-developed industries. These types of companies are often best suited for the dividend discount model. Right? And the reason that this is the case is because if you can better predict future dividends, then you can better take the present value of those future dividends to determine what the company is worth today. But if dividends are not very stable and they fluctuate quite a bit, it's going to be hard to project into the future. And so what goes along with the dividend discount model is also the constant growth or the Gordon growth model, right? And it is widely used to determine the intrinsic value of a stock based on a future series of dividends that grow at a constant rate. Right, it's a popular and straightforward variant of the dividend discount model. So all you're doing there is just taking the future dividends as if they grow at a constant rate, which some companies do. If you think of the dividend aristocrats in the market, they can fall into the category that you could potentially use the Gordon growth model for those companies to determine some valuation. But what we want to do in both of these instances is determine what future dividends are going to be in the dividend discount model several years into the future, and for the Gordon growth model, just the future dividend 1 year forward. And then also, what is the required rate of return for investors? And that's a whole nother can of beans that you can open on your own, right? That's not something we're going to dig into in today's episode. But you need to determine what the required rate of return is for the investor and what the growth rate of dividends are going to be moving forward. And you should be able to come to some determination of value today. Again, you can look these up. These are not extremely difficult, but they're very popular in finding the intrinsic value or absolute value. But when we are looking at this absolute valuation, and let's say we have a company that does not pay any dividends, well, it's problematic when it comes to the constant growth, the Gordon growth model, or the dividend discount model, to use a company that doesn't pay dividends, because dividends are zero, right? But obviously companies do have value even if they do not pay dividends. Well, how can we value those types of companies? Okay, well, one of the most common ways that you can do so is through the discounted cash flow approach. So again, we are trying to take the present value of future cash flows. So instead of looking at dividends as future cash flows, here what we want to do is we want to come to the free cash flows that the company has, right? We want to take the company's free cash flows, forecast it out, and then determine what the present value of that company's free cash flows are. Now, again, problems with this absolute valuation method are that you are going to have a hard time forecasting future cash flows. It's difficult to forecast future cash flows. It's difficult to say for a company that is not stable and growing at some relatively stable rate, or a company that is very volatile in its earnings or volatile in its cash flow. It's difficult to say what future cash flows are going to be, and therefore even more difficult to determine what the present value of those future cash flows are going to be. Okay, so when we're determining this, when we're determining what the present value of future cash flows are, we have to have a pretty good basis by which we determine those future cash flows, or else we can be in some big trouble. Okay, so to use the discounted cash flow model most effectively, the target company should generally have stable, positive, and predictable free cash flows. Companies that have the ideal cash flows suited for the discounted cash flow model are typically mature firms that are past their growth stages. And so this still leaves a huge hole for us, right, in determining the absolute valuation, because we still have these companies that are growing fast. How do we put some value on these companies that are growing quickly? I'll just tell you, it is very, very difficult. It's very, very difficult to come to some type of valuation of a company that is growing very, very quickly. So something that you could also look at is the comparables model. And so the last model is a sort of catch-all model, and it can be used if you are unable to value the company using any of the other models, or you simply don't want to spend the time crunching the numbers, okay? This is something that may come in handy when we are talking about companies that are more growth-oriented companies and are not as stable in their cash flows and in their dividends, okay? So this model doesn't attempt to find an intrinsic value for the stock like the previous two. Instead, it compares the stock's price multiples to a benchmark to determine if the stock is relatively undervalued or overvalued. The rationale for this is based on the law of one price, which states that two similar assets should sell for similar prices. The intuitive nature of this model is one of the reasons it is so popular. Okay, so the reason why the comparables model can be used in almost all circumstances is due to the vast number of multiples that can be used. Now, this really brings us to understanding better what different types of multiples are and how we can use them in our valuation. So I want to just go over a few of those with you, and hopefully you can come to a better understanding of what exactly they mean. Okay, so one particular multiple is the price to book multiple. Okay, so the price to book value ratio represents the value of the company if it is torn up and sold today. This is useful to know because many companies in mature industries falter in terms of growth, but they can still be a good value based on their assets. And so Ben Graham, the father of value investing, paid a lot of attention to the price to book value. He tried to purchase companies that were at a steep discount to their current book value, although that is very difficult to find nowadays. But he would find companies like that and find them at undervalued relative to their assets, and then allow the companies to appreciate based on what the value of their assets are. Okay, so with purely financial firms, the book value can fluctuate with the market, as these stocks tend to have a portfolio of assets that go up and down in value. Industrial companies tend to have a book value based more on physical assets, which depreciate year over year according to accounting rules. In either case, a low price to book ratio can protect you, but only if it's accurate. This means an investor has to look deeper into the actual assets making up the ratio. Okay, so again, the price to book value. We are looking at the book value, okay, of the company's assets. We're looking at the current book value. And if you are doing that, if you're going price to book value, then the lower the price to book value is, the cheaper the company is relative to its assets, okay? But the higher the price to book is, the more expensive it is relative to its assets. And that's why in the comparables model, you may use the price to book and compare it to another company of similar size, of similar industry, of similar business, because you would look and say, okay, is this company cheaper or more expensive relative to its peers? And the price to book can tell you that. Now, the price to book is one of the stricter ways of looking at comparison, because just saying that you are cheap relative to your assets or relative to the company's equity is not as useful in most cases for most companies as it is to say, is the company cheap or expensive relative to their earnings or their sales or their earnings growth, okay? And so we take all those things into account in these next few multiples we're going to talk about. The next one we talk about is the price to earnings multiple. And this is one of the most common multiples that you can use for stock valuation, okay? So price to earnings, we're literally saying the stock price divided by the per share value of the company's net income. So net income divided by the number of shares, that is the basic EPS, the basic earnings per share. Okay, so you get the price to earnings, and you can compare two companies' price to earnings to determine how overvalued or undervalued one may be relative to the other. So in all of these cases, we're looking at relative valuation. It's only relative to one another. Just because a company has a price to earnings, let's say of 25, doesn't tell me anything about that company and its current valuation. You can only compare it with other companies or itself over time in order to make any sense of exactly what we mean by this price to earnings multiple, okay? But again, in the same way as we looked at the price to book, the lower the price to earnings means the cheaper relative to its earnings that a particular company is selling in the market today, okay? Then price to sales. Price to sales is very commonly used for growth companies because a lot of growth companies either do not have earnings, right? Positive earnings. So their net income is negative currently, so you can't get a proper gauge of a price to earnings ratio, or their earnings are very, very low right now relative to their price. And so their price to earnings is through the roof, crazy, crazy high, because let's say their earnings were like, 12 cents a share. Well, that may blow up your price to earnings ratio. So what you may want to look at is price to sales. And price to sales can be very useful because you can say how expensive or cheap is a company relative to their revenues. So if a company may have a high PE, but let's say they're relatively cheap compared to their revenues, then we may be looking at a company that is a good growth stock that can be invested in over the long term. But again, this is the price, the current market price, divided by the revenues for the company in a particular year, divided by the number of shares. So revenues per share, okay? So that would be the price to sales. Then there is the PEG ratio, which I talked a little bit about earlier this week, the PEG, right? That's price to earnings. So the same thing as the price to earnings ratio that we looked at already, but then it's price to earnings to growth, okay? So PE over the growth rate stated as a whole number, so 12%, would be stated as 12, okay? And you will get the PEG ratio. Once again, the lower the PEG, right, the cheaper the company is relative to their earnings and the growth of their earnings, okay? So what this does is this, again, can be a good technique to use when it comes to growth companies because, yes, taking a PE into account is important, but if you can take a PE into account along with the earnings growth of a company, that can really help you to determine if a company is selling at a premium or at a discount relative to others that are like it, okay? But again, all of these are being used as relative techniques. You can only compare them either with other companies or with themselves over time. So if a company is selling really cheap to earnings compared to what it has in the past, you may ask yourself why. Or if a company used to be valued higher relative to sales than another company, but now it's not, you may ask yourself why, and be able to do some relative valuation in that place. So that is where we're looking at this comparables model, okay? And these different ratios are all used, but the PE ratio is the most commonly used because it focuses on the earnings of the company, which is one of the primary drivers of investment value. That's why when we are watching CNBC, keeping up with financial news, it's called an earnings announcement. Even though they talk about all different financial metrics, it's called an earnings announcement because earnings is so important. So the E part of that PE is very big when it comes to driving a firm's stock. Okay, so you can use the PE multiple for a comparison. You can typically use it if the company is publicly traded, since you'll need both the stock price and the earnings of the company. The company should be generating positive earnings because a comparison using a negative PE multiple would be meaningless, and the earnings quality should be strong. So this means that the earnings should not be too volatile, and the accounting practices used by management should not distort the reported earnings drastically. So again, we still rely on some different things going on within a firm in order to value a company properly. Okay, so these are just some of the main criteria that you should use when choosing which ratio or multiples to use. So if the PE cannot be used, so choose a different ratio, such as the price to sales or price to cash flow, which we didn't talk about, but works in very much the same way as the price to sales. Okay, so the bottom line is that no valuation model fits every situation, but by knowing the characteristics of the company, you can select a valuation model that best suits the situation, and you're not limited to just using one model. Right? You can use multiple models and then compare the outcomes of the different models to make your decisions. So with stock analysis, sometimes it's not a question of the right tool for the job, but rather how many tools you employ to obtain varying insights from the numbers. Okay, so you can do multiple things and then see if you come to the same justification or the same reasoning behind exactly what decision to make for a particular company and whether or not you should go about purchasing that particular company's stock or not. Now, I do think it is important to just step back for a second and remember that if you're going to go about valuing a company, you should already have some basis for which you are interested in that company's stock. That company should be interesting to you. You should understand their business in some way before you do any type of fundamental analysis, okay? And you also need to keep in mind that there are many companies out there that it is going to be hard, if not impossible, to value in some way. There are a lot of very young companies that it's hard to compare them with others. There's companies that don't have a lot of stability in their earnings or their sales, or they may have negative earnings. It's very difficult to put a value on some companies. And that's why in most cases, I don't even invest in companies that don't have positive earnings. Okay. And if they didn't have positive earnings, then they would have to be so convincing in their other numbers and their other fundamentals that I thought that it was, very prudent to still invest in them, even though they hadn't made it to profitability yet. Okay. But that is extremely rare. And not only is that rare, it's rare for me to invest in something that does not have any type of stability when it comes to earnings or revenues or things like that. You want to see growth, and you want to see predictable growth into the future, or else putting some type of value on a company is going to be very difficult. And at that point, you are very likely speculating. We need to remember that as well, that if we are just buying something based on a feeling or based on the fact that we like the business and we're not doing our homework, we're not doing the fundamental analysis, we're not trying to put some type of valuation, whether it's absolute or relative, on that particular company, then we are not investing, we are speculating. Okay, and if you are speculating as to what a company will do or what a stock will do, because very often if you're speculating, you don't care much about the company, you care about the stock. If you only care about what the stock is going to do in the short term, then you're not investing. You are absolutely speculating in that company, and it's likely to not turn out too great for you over the long term. Okay, but I really encourage all of you guys that if you are interested in learning how to value a company better. Do your homework. Understand different viewpoints that different people have. These were some basic valuation models I talked about today, but I will say this. A lot of people like to use relative valuation as opposed to absolute because relative is easier. It doesn't require as much accurate forecasting. But for more stable companies, absolute valuation can be the best way to go and the best way to understand what a company is actually worth, right? So give it a try. Do your research. Understand these valuation methods better. You'll actually have a basis by which you can begin learning more based on this video, because I by no means gave you everything that you needed to know here because I just didn't have the time to give you everything that you need. It would take several hours to give you everything you need on stock valuation, but I wanted you to have a beginning point, and I wanted you to have a point by which you could go ahead and take and start applying it to your own single stock selection, and you can start doing your homework in an effective way. So hopefully this helped. Hopefully I gave you some metrics and some methods to look into, and hopefully you can begin to do your homework and pick individual stocks in a prudent way. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about single stocks being too risky, right? So that's the idea behind tomorrow's episode, because most people see single stocks as being too risky. And I've told you that there is a lot of risk inherent to single stocks, but we're going to break that down tomorrow, break down exactly what that risk looks like and how maybe you can mitigate some of that risk if you are trying to buy individual stocks, which again, not everybody should be doing. So thanks for tuning into today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.